This is Money Talks. I'm Greg Bogle, Portfolio Manager at GKV Capital Management. We've talked a lot about the importance of the fundamentals. How much a company earns is critically important to the value of the stock. The difficulty is the value of the stock isn't based so much on what the company earned last year or even yesterday. It's based on what the investors think the company will earn tomorrow. This is what makes the stock market so difficult to forecast. In many ways, forecasting economic data is more an art than science. Analysts frequently are off in their company forecasts. CEOs and CFOs are often not any more accurate in the businesses that they run. We've had a fantastic run in stocks since the onset of the pandemic. From the low on March 23rd last year, the S&P 500 is up 93% through the close of the third quarter on September 30th. Although the major indexes are up nicely this year, the S&P 500 gained 15% through September 30th. The gains in the third quarter have stalled. From June 30th to September 30th, the S&P 500 gained only 0.2%. So it's a fair question to ask that if the earnings outlook for this year and next looks so great, why have the equity markets stalled? Here's a chart, annual combined earnings for all the S&P 500 going all the way back to 1988. The red line is the value of the S&P 500 index. You can clearly see that the value of the market is correlated to earnings. So, if I want to know what direction the market is going, I need some idea of future earnings. The strength in stocks from the low we talked about in March last year was based on the expected economic recovery. The recovery has been fantastic. And you can see from the dramatic reacceleration in earnings this year over last year. We're a little more than 2/3 through the year, and the current forecast is close to $200 per share for the S&P 500, which is easily an all-time high in earnings. In 2020, we hit $122 per share. This year, at $200 per share, that's a 62% increase. As we continue to get past the economic disruption of the pandemic, earnings are expected to continue to grow in 2022. The current forecast for next year is $217 per share, which would represent 10% growth over this year. 61% earnings growth is unheard of, and the strength in the stock market has reflected that. 10% earnings growth is still a decent number, but it's far closer to normal. As 2021 comes to a close, investors increasingly look to 2023 and what kind of earnings growth we might see in the future. There was a lot of certainty that earnings would accelerate from the depressed level of the 2020 after the forced economic shutdown in the pandemic. The success of vaccines and massive government stimulus did what they were supposed to do. The uncertainty was more about the timing of the recovery and just how fast earnings could recover. As we head into 2022, it's less clear what kind of economic growth we should anticipate. There are lots of reasons to be optimistic. Household income is strong. Unemployment continues to fall. Consumer demand has driven positive trends in retail spending. Energy consumption has rebounded, and travel and entertainment are still in the process of recovery and will add further to earnings growth next year. And then there's the things to be concerned about. The lingering impact of the pandemic is still with us. The supply chain bottlenecks are significant and are affecting earnings in certain sectors of the economy. The combination of supply chain disruptions and dramatic reacceleration in demand after the pandemic are raising costs, pushing inflation above 5% for the first time since 2008. Inflation hasn't been above 5% for a protracted period since the 1990s. Most economists continue to believe that the rise in inflation is transitory as we exit the pandemic, but some of the supply chain issues seem lasting. Energy prices are hitting recent highs, with oil now over $80 a barrel. The risk of continued rising inflation may force the Federal Reserve to hike interest rates sooner than we would like, which would slow earnings growth into 2023. The political dysfunction in Washington is also an overhang on stock prices. Wall Street would generally favor a passage of an infrastructure spending bill, but wants to see no more than limited increases in taxes. Using the debt ceiling for partisan grandstanding creates considerable anxiety on Wall Street. The mere prospect of the U.S. government defaulting on its debt is unconscionable. Fortunately, while politics is very important to a lot of people, they don't generally have a big impact on economic activity and earnings. Politics shouldn't be ignored, but most people put more import on Washington machinations than necessary. On balance, we're positive on the outlook, but earnings growth is necessarily slowing. There are risks, but the economic data is very positive looking into 2023. Certainly, this outlook can change without notice, but 10% earnings growth in 2022 is strong, and there is some reason to believe that there is a possibility that the estimates can increase further, which would be positive for stocks. Thank you very much for joining us. Please feel free to leave any comments or questions below.